Hi, this is Larry Maddox, President of Horizon Advisors. Today we're presenting our 2013 investment look. We did this a few weeks ago for a group and thought it might be useful to share it with the rest of our clients and friends. Presentation consists of 18 slides and will take about 10 minutes. We hope you find it interesting and informative. To set the stage, we wanted to look at 2012 first and see what happened last year. On the economic front, real GDP grew at 2.2% and unemployment improved from 8.5 to 7.8%. Last year the S&P 500 and high yield bonds rose about 16% each. These are what would be considered riskier asset classes, and they did quite well last year in terms of return. U.S. Treasuries, on the other hand, the safest of assets, at least in the 10-year bond, rose 2% last year. Not bad, but certainly not on a par with what happened on the equity side or in the other higher yielding bond categories. 2013, our investment themes are that investor confidence remains very fragile. The U.S. economy is getting stronger. It got stronger last year and will continue to get stronger this year. Risk in terms of equity and higher yielding bonds remains relatively inexpensive, and safety has gotten even more expensive than it was last year. So let's look at each of these themes in turn. We've got several slides on each one. So first, let's look at investor confidence. This is a graph of the last 12 years, more than 12 years actually, but the last 12 years have been a pretty unpleasant time to be an investor. We've had an awful lot of volatility and not much in the way of returns. We've come from the dot-com disaster through 9/11 to one recession that ended in 2002 and another one that ended in 2009. We've also had the financial crisis that began in earnest in October of 2007, and then we've had this recent really nice recovery in markets to our current market at the end of December 2012, and actually this up market has continued into the new year. But it's just been a hard time to get anybody very excited about stocks because they've been so volatile, and people are afraid of what might happen. Rocky Rapa, we've had political gridlock for the past, gosh, looks like it's been going on for a long time. These are congressional and presidential approval ratings. You can see congressional ratings are about as low as they've ever been, and presidential ratings are a little bit higher, but still not up to the average that we've seen over longer periods of time. So I don't think people have a lot of faith in the government getting anything done, although they actually did get something right with the recent Tax Act, I think. The lack of confidence and the government's inability to change everybody's attitude has resulted in huge outflows of funds from stock funds and into bond funds. And since 2008, $371 billion has flowed out of U.S. equity funds, stocks, and $921 billion has flowed into taxable bond funds. You can see this graph just shows the downward part here are flows into bond funds. We've just had a short period of time when there were inflows into stock funds in the past 5 years. We actually had, it's not shown on this chart, this is a little bit dated, we actually had inflows in January of 2013, so perhaps the tide has turned, but it certainly was a lot of money flowing into bond funds over the past 5 years. And you can see with the flows into bond funds is investors have missed an opportunity. This lower green line reflects the returns on bond funds over this time period, and the more volatile orange line is returns in equities. And you can see here up at the top that equities, stocks have risen about 72% over this time period since March or December of 2008, and bonds have risen about 27%. Not too shabby, and it's been a nice time to have a diversified portfolio, but clearly stocks have done a whole lot better than bonds, and all those people that, as we say, stampeded into the bond funds missed an opportunity on the equity funds. So now let's take a look at the economy real quickly. The economy is continuing to improve. You can see that real GDP, this is a chart of real GDP on a quarterly basis, and basically we had this huge loss output during the recession, and all of that and more has been recovered since the end of the recession. So the 20-year average GDP is about 2.5%. The third quarter of 2012 it was 3.1. We just recently had a downtick in December, but I think our year end was 2.2%, so a little below average, but still positive and improving. And part of that improvement is due to a decrease in unemployment rates, and we've gone from a high of 10.1% to a low of 7.7% in November, and I believe it's gone back up to 7.8% as of the end of the year. But unemployment is improving. It just takes, as you can see in the past, when we've had big spikes in unemployment, it just takes a long time for the job market to recover. One of the things that will really help it is if the housing recovery continues, and we're seeing that the housing market is bottomed. We believe the recovery is underway. These are three, on the left hand side, three indicators of housing prices. You can see they all declined substantially during the recession, bounced along the bottom for 3 or 4 years, and beginning in 2011 and through 2012 we've seen actually an uptick in home prices. The same things occurred in housing starts on the right hand side. You can see our average housing starts are about 1.4 million per year. Our recent reading in November of 2012 was 861,000. As these housing starts continue to improve, we'll certainly see an improvement in the job market. As you can see here in the text section of this slide, the National Association of Home Builders estimates there's 3 new jobs for every new home that is built. So returning to a new level of a more normal housing level of housing construction will make a big difference in the unemployment rate. So let's take a look at the stock market. The S&P 500. This is a graph going back to 1992, and you can see that the PE ratio of the S&P 500, the price to earnings ratio, on average is about 16.1%. It got obviously much higher than that during the dot-com period, and has just dropped on a pretty steady basis to well, actually it was a little bit lower than it is now, but as of the end of December it was 12.5. The price earnings ratio was 12.5%. That's about 23% below its long-term average. So that's a historically relatively low valuation, and generally an indicator that equities are reasonably priced and poised to increase. But some equities are more equal than others. This is a graph that basically shows different sectors of the S&P 500 and what the valuations are like in each of the sectors. You can see on the left hand side over here that the S&P 500, as I said earlier, is about 23% below its normal price earnings ratio, and in the cyclical sector right here, most of the stocks, most of the sectors of the market are undervalued relative to their long-term average. For example, energy is about 40% under its long-term average. Technology is about 45% under its long-term PE. On the defensive side, which is where most of the equity money that has gone to equities has gone in the last couple of years, telecoms have been bid way up. They're selling at almost twice their normal PE ratios, and utilities, which usually don't vary very much, are also well over their normal PE ratios. And these are just indicators of areas where there's been a lot of money seeking returns and yields from dividends, which are more common in telecom and utilities than they are in the energy and technology side, although actually energy has some pretty good dividends too. We just think it's important as you look at the as you look at your equity portfolio to be looking at the less overvalued parts of the S&P 500 rather than the ones that have run up so much lately in value. On the bond market side, we say safety is expensive. This is a graph of U.S. 10-year U.S. Treasury yields since 1962, and you can see over the last 3 decades we've had a long period of declining interest rates, which is as interest rates decline, bond prices go up. So we've been in a major bull market for bonds over the past 30 years, and we think that's getting nearer to the end. We don't know exactly when it'll turn, although the recent, it's February of 2013 as I speak, and today's 10-year Treasury yield is 2%, is about 2%. So it's gone up rather sharply over the last month. Safety is expensive. You have to just be very careful about where you invest for bonds. This graph shows U.S. Treasuries at the top and other sectors of the bond market at the bottom. You can see the 2012 returns on the right-hand side. These were pretty modest, although positive in the Treasury market last year. They were actually much better in the more risky parts of the bond market last year. However, when you look, let's take a look at high yield bonds. Here's the next to the bottom one here. Last year we had a return of about 16% on high yield bonds, as yields went from 8.3% to 6.13% at the end of the year. This yield compression has basically pushed up prices of high yield bonds, so that any increase in interest rates is going to be can result in some pretty significant losses in the bond market, just reversing the trend from last year. And we're particularly that on the Treasury side of things. So when safety is expensive, as it is right now, the risks to holding safe investments are higher. Remember, we said when interest rates rise, bond prices decline. So if we look at, obviously interest rates can go up or go down, and this graph represents what happens with a 1% rise or fall in interest rates. But if we're more expecting interest rates to decline, we might look at the 10-year Treasury bond right here. It's expected to decline by 9.1% if interest rates go from our current rate of 2% to 3%. A $100 Treasury bond will be worth $91 at the end of that time period to account for the higher yield. The same thing will occur over on the right-hand side, which are the more risky areas of the bond market. We just think you need to be very careful to keep a close eye on interest rates, and particularly rising interest rates with your bond market investments. So our outlook for 2013 kind of starts out with cash on the sidelines. Companies have a lot of cash on their balance sheets. They've been waiting for regulatory clarity. We obviously got the healthcare law resolved. We've gotten the new administration, or the same administration, back in Washington, D.C. That should at least let people start thinking a little more long term. We also have very high household cash balances. This graph at the bottom represents household cash balances, and these cash balances have been increased at the end of the year by the accelerated asset sales, which people entered into last year knowing that capital gains rates were going to go up from 15 to 20%, as well as the surtax of 3.8%. We've had accelerated gifting at the end of the year as taxpayers anticipated a decrease in the exemption amount for gift taxes, and a lot of families made significant gifts at the end of the year. So there's cash from those gifts that's on the sidelines. And on top of that, as you know, we've had special dividends and income payments out of companies last year to take advantage of the lower rates. Last year, the highest rate for 2012 was 35%, and for 2006 dividends go up to 20%, the same as capital gains, and income for higher earning individuals is going to go up to 39.6%. So we think we had an addition to the cash on the sidelines, and when it can't find any yield in the bond markets, it's liable to move into the stock market. So our outlook includes improved visibility for this year. The economy continues to recover, and I think the longer it continues in the recovery, the more people will feel like it's going to continue. Europe is beginning to stabilize. The election's been decided. The health care law is going to be with us for a while. Tax policy, we feel like that was a decent resolution to the tax part of the fiscal cliff, and we think that we could end up with some additional, we're certainly in the midst of negotiating right now on how to handle the spending side of the fiscal cliff, but hopefully Congress will be able to make some progress on that side. But the number of uncertain outcomes has certainly been decreased. And finally, we'd like to make sure that you keep things in perspective when you're investing. This is a long-term graph of the S&P 500 from, I guess, gosh, it's 1900 it says. And what you see here is long-term bull markets punctuated by shorter term but still miserably long bear markets. we're late in our current secular bear market, and we think at some point we should break out of this and start another upward leg, as has happened historically. One of the things we talked about earlier is, which makes the market more compelling, is price-earnings ratios. You can see this at each one of these bear markets that we have here. The last one in 2000, start PE ratios were almost 30%. They've declined to about 15% now. In 1963, they declined from 19% to 12%, and so on. That's always been the case, and once PEs get compressed enough, it makes stocks a much more attractive investment. So our recommendations for this year are to stay diversified, to remember that the U.S. economy is improving, and try to relax a little bit, take some comfort in there. We think you should add risk opportunistically in the more unloved places of the market, as we showed in the heat map earlier. We think it's important that you do not overpay for yield, either in the equity market or the bond market. High dividends and high yields have tended to drive up the prices of the underlying investments, so we need to be careful about that. And finally, we think it's very important to invest with caution in the bond markets, and in particular, I think, to avoid long-term treasuries. Said that finishes off our presentation. We wish you all the best of luck in 2013, and please feel free to contact us if we can help you in any way. Thank you.